Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen. While I'm sharing my screen, if anybody is joining us for the first time, Will and I, we do this show in the mornings to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we provide a link to Zoom. It's in that live chat on YouTube. Click on that link. It takes you over to Zoom. When you're in Zoom, there's a button at the bottom of the screen. It says raise your hand. Click on that. When we let you in, you don't have to turn on your video camera. When we let you in, you could ask your question live, direct. Everybody could hear you. If you prefer to type in your question, type that into the live chat on YouTube. Will's watching it. He'll read it back to me. While we're waiting for questions to come in and for more people to join us, we'll start out taking a look at the pre-market report, see what's trading in pre-market hours, if we could get some insights from that. If we don't have questions come in, I'll just navigate to a different section of the website and we'll take a look at some other reports, see if questions arise. So let's start out with the pre-market report, Will, and then you'll let me know if you get any questions. So pre-market report, these are stocks that are trading in a pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, and I see 58 stocks made our percentage gainers list, 20 on the decliners. So from that perspective, right now, we're looking like we're setting for more bullish bias at the open. But if we look closer at that list, we do see that there are stocks on that list that are low market cap stocks. We have ETFs, leverage products. It can be closed-end funds, preferred stocks, anything that's listed on the major U.S. exchange. If it's trading in pre-market hours and meets our threshold, it can make this list. And what we want to do is narrow down this list to a smaller group of stocks. We want to see if we could get a more focused group. And to do that, we could use the filters here above. And this filter in ETF, we're going to use that one. I'm going to click on it. It drops it down. We get a list of ETFs to choose from. We see that there are sector ETFs and there are broad-based ETFs. The top one, SPY, that is the S&P 500 ETF. When you click on that, let's do that, SPY, and click on that, the data tables below will get filtered by stocks that are holdings in the SPY ETF. And here we see we got 5 stocks that made our percentage gainers list, 3 on the decliners. So from this perspective, looks like slightly bullish bias, but pretty much, flat at the open, I would say. Let me see if we have questions, I'll take those. If not, I'm going to navigate, to a different part of the website.
Let me see. Nope, no questions have popped up yet.
Okay. So I think let me come to SPY. And I'm going to come here to the fundamentals. So on the SPY, while I'm coming to this, and while I'm thinking about it, because I'm building some internal models that eventually I'm going to push out. But I think that one of the interesting questions that we're getting, I think, during the shows were why do we see a disconnect between certain asset prices right now, or securities? We had a question, well, why is the VIX low if we're in a banking crisis? Or why, why is gold elevated, when interest rates are moving up? And when we look right now at the asset prices, as interest rates are going higher and there's uncertainty, price assets, there's a dislocation, right? It becomes harder to price things, less liquid, more uncertainty about future forecasts and expectations, and we will start seeing dislocation of asset prices. They don't act and behave in correlation or in ways that we start to expect, right? That starts to happen when you're removing liquidity, when assets and risks are harder to forecast, harder to place a value on it, and all of a sudden there are things that are looking that they're not quite adding up. Okay, and I'm going to show you one place, where it's evident that doesn't make sense and something is going on, and it could create opportunities, for people who do know how to put value and prices on assets, know how to hedge and so forth. But I'm going to show you here the yield curve right now. So this is, you see my Excel spreadsheet. How do I hide this top part? Hold on a second. Let me see. I just hide that part. Okay. So this over here, these are, before I show you this here is the latest yesterday's treasury yields, and they give you a term structure: 1 month, 2 months, 3 months, going out 1 year, 5 year, and so forth, up to 30 years. And usually a yield term structure is smooth. It's either, it'll slope up, right? So it'll start out with interest rates, and as you move out further out into the curve, interest rates slope higher, right? More uncertainty, more inflation, you have a longer duration, it's going to slope higher. Then there are times when a market is forecasting potential recession, and it thinks that if we do hit recession, there's going to be deflation and interest rates are going to have to come down. You're going to have an inverted looking yield curve where the interest rates are higher right now because the Fed has them high, but if the expectations are that they will lower, it will move down and slope lower. But look at how it looks right now, right? If we look at it, we're seeing it jagged. Like, look at, it starts from here, starts moving up, then starts moving down, then starts moving up, and it looks jagged. And when it's very jagged like this, then it's signaling something else, that things are harder to price. Things are not getting spread off as usual, and there's friction in there, okay? Because it shouldn't be very jagged, and let's just take a look at this. You could see here how it looks, bumpy. The more jagged it is, the more bumpy and not smoothed out, the more that it's something going on where, the market forecast, there's lots of disagreements. Things are not getting spread off. They're not getting hedged. Maybe there's high demand for one type of security, low demand for another. But when you start seeing things very jagged, that's telling you that there are things going on in the market out there that are creating these dislocations. Like why aren't things matching up? Like why, people, there's risks that are being priced into the credit markets, right? What we're seeing is, well, why are the interest rates moving down? Inflation is moving up. The market forecast is interest rates going down. The Fed is saying we're not going down, right? They're saying we're not moving interest rates down. Not this year, no way. We're probably going to move up another 0.25%. And they don't see themselves moving down for a while, until inflation hits 2%. And inflation is nowhere close to 2%. But this is signaling that they think that the Fed is wrong and that we're going to hit recession, and it's going to be the recession or the panic in the markets, whatever it is going to force the Fed to ease and cut rates. But for that to happen, something bad's got to happen, right? Something bad has to hit the markets for the Fed to be forced to do that, because then, why are they going to give up on their battle on inflation? Why are they going to have to move? What kind of systemic risk is there that the interest rates have to go down? Because it can't be just the SVB bank, because that's not pulling, that's not right now pulling everything lower, right? So far, it seems contained. So, and if this is the case, if the bond market is signaling this, then the question is, and why isn't the VIX signaling this? Why aren't people going out there at the same time looking at the bond market and buying puts, right? Because then you would think that something so serious has to happen. Why aren't we seeing a lot of put buying going out in the longer dated options? And those people who are betting on the bonds, why aren't they buying the puts as well? If they're so confident buying 10-year bonds at 3.5%, while the Fed funds is at 5% and indicated to stay there and maybe go higher, well, then how come they're not buying puts if they're that confident, right? If they're that confident. This is a good question, because things right now, as interest rates go up and you're pulling liquidity, that's what happens, is that asset prices become dislocated. They're not matching up with each other. They're not all agreeing on the same forecast. And I would say that based on what we're looking at, if we're comparing the operating yield, versus the risk-free rate, and I'm looking at the equity, the earnings yield premium, the stock market is forecasting something different. The stock market is actually forecasting that either maybe the earnings are going to go up, and they're going to go up by a lot, or they might be saying that, okay, interest rates may come down, which would expand and make that earnings yield premium higher, but it will happen without the market going down, right? Without really earnings forecasts changing. So the equity markets right now are not showing, neither in the risk premiums, in the puts, or in the options, or even in the earnings yield premium, are not really agreeing with that there's going to be some severe recession and a hit to the equity markets, right? That's not in agreement with what the bond market is indicating. And I think actually, was it BlackRock that came out and said that they don't even think that the bond market is getting it correct? It could be the case that the bond market right now, is not getting it correct. And if they are, then we definitely don't see any signs yet in the equity markets, right? We don't see those signs in the equity markets. And that's one of the things we do get questions. Well, what's going on? What's going on with the VIX? What's going on with gold? What's going on with, the traditional risk premiums? Things are not lining up. And part of that is when you start taking out liquidity and raising interest rates, it becomes harder to forecast, harder to price things. You're creating more uncertainty in those models. And let's just take, for example, here, whenever you're pricing a risk asset, right? Whenever you're pricing a risk asset, well, your first benchmark is the Treasury risk-free rate, right? Because that is considered the risk-free rate. There's no default risk by the U.S. government. They could print more money, but you do have duration risk, because as you go out further in time, those interest rates could change because they're reacting to new information that's constantly coming in. So it's going to react to information that is right now unpredictable. We don't know what the new information will be in. Are going to react. But when you have this choppiness, what yield do you use? If you want to calculate what is the risk premium, how much right now am I earning above the risk-free rate? Well, then if your model is pegged to the 5-year, right? If your model is pegged to the 5-year interest rate benchmark, you're more than 1% away from the Fed funds at this point. And look, you're 0.9% away, from the 1 year. And that is a big difference it'll create in your forecasting model. If you're trying to price out, if you're based on trying to forecast 5 years of earnings and earnings growth, and you want to see, well, how much, earnings yield premium am I getting above the risk-free rate? Well, which one do you use? You could use the 5-year. Do you use the Fed funds, or do you use the 1 year? Because that itself will make a drastic change in the valuation of, equities. And this is a problem. Not only that, what was the 5-year alone, or I think even the 10-year? Let's look at the 10-year. The 10-year, going out 10 years, that alone moved, I think, from 4% down to 3.5% really quickly. So the volatility in that interest rate is already high. And that's becoming a big problem for models trying to, price assets in this market. It's going to become a very big problem when interest rates are moving around, because no matter what asset you're pricing, bonds, options, equities, real estate, insurance, whatever you're pricing, you're going to peg it to the risk-free rate. You're going to reference the risk-free rate. And those rates right now are starting to move around, and you could see that they're not smoothed out, they're jagged, and then it becomes an issue of which rate do you want to reference? Because if you believe that the bond market is wrong, if you believe that 3.6% or the 10-year 3.5% is getting it wrong, then you may not want to even reference that anymore. You may want to reference, the Fed funds rate or what they're saying, or create almost your own benchmark, because this has moved already, from 4% to 3.5% in a matter of like a week.
That's a big move.
It's a really big move in interest rates, especially on a long dated interest rate. And it created problems for banks. It's creating some problems for Charles Schwab right now. I think Charles Schwab is now sitting on a $29 billion unrealized loss. Okay. Yes, if they hold it to maturity, they'll get their principal back. But
now they can take it to the Fed window, discount window, right, and get par for them. Is that correct?
I don't know exactly how it works. I'm not sure if you could just take it and get your money par. I think maybe you could borrow against it at par. Something, if you need liquidity, they're taking it as collateral. But you can't just go and sell them at par.
It's not like you can go. It's not like you can take them off. You can't take them off your book and give them to the. Yeah.
Yeah, they won't let you just flip it out for a profit. So I don't think it's like an arbitrage opportunity when you go into the market.
That would be
wonderful.
Wonderful.
Into the market, buy it at a discount, and flip it back out.
Well, I'll tell you, it is amazing because there's so many people who have said that for years, right, that the treasuries lead and the bonds lead the stock market, and the amount of volatility in in the movement of the bonds seems like historic, and the fact that the stock market is just seems pretty tame, right? You would have thought,
given the interest rate moves in the bond market, and again, there are asset prices, from what's going on in the credit markets, interest rates, commodities, the Fed, the CPI, and the equity markets are not lining up, right? They're not really lining up the way you're expecting them to line up and behave, and they're starting to move apart. The equity markets, I think, are starting to move apart from what the bond market is signaling, and the bond market is moving away from what the Fed is signaling, right? They're moving. I think at this point, the bond market is saying we're going to be cutting like by June, right? I think that was the forecast by the bond market, that the Fed is going to be cutting interest rates by June, and the Fed's saying there's no way that given the data that they're looking at, that's going to happen. They said no cuts this year. There's no cuts in 2023. Again, things are moving apart and away from, how you would think asset prices would be correlating, and I believe that even with
things breaking apart like that, don't you think volatility would exist?
Well, yeah. Why is volatility tame, right? Why is the volatility itself? And we've been getting more volatility in the stock, but it is tame. And let's just take out, let me come over here. Let's look at the open interest in SPY. And if we look at the open interest, we do have some open interest yet in April, but going out further in time, there isn't that much, open interest or spike in demand for puts, not in the SPY at least. It looks pretty tame here, and most of the volume that is in the SPY. Let's take a look. In S here, this is an SPY. This is the option volume. Most of the volume remains in those short dated options, the 0 DTE, and then the next day out, which, by the way, that if you start getting in trouble and the market starts moving, they're not going to offer you protection a week out or 2 weeks out. Those option prices are going to start changing. It
is amazing because you also have, I mean, it's, the whole raising of more capital for the government, that's coming, ticking up, right? And they have to pass that amendment by, what is it, June or July? I mean, it's like
to raise the debt ceiling.
Yeah, the raise the debt ceiling. And yeah, I heard Senator McCarthy talking today, and there has been literally zero, not even a meeting with the president to get anything done.
Right.
Not that means anything. But they're pricing it like there's no risk.
Right. And everything on the fiscal side right now is inflationary. When we had deflation and the market started going down, monetary policy and fiscal policy were both on board to inflate. It was like a new, they launched like a nuclear missile against deflation because the government had no problem increasing spending, lowering taxes. The Fed had no problem, lowering interest rates to 0, buying assets, outright just buying assets, lowering mortgages, easing up on the lending practices. And, the government even gave direct deposits, just put money into people's bank accounts. But the inflation, they're not panicking. When we had inflation at 8%, we didn't have a nuclear missile launched at fighting inflation. It is maybe, we're like shooting rockets at it because, the Fed raised interest rates pretty quickly to 5%, but that came from 0%. But it's not like, look how they're piecemealing their balance sheet. If something SVB Bank happened, all of a sudden they've pushed out $165 billion in liquidity into the markets. On the fiscal side, we're still deficit spending. We're not trying to create a surplus, not from raising taxes, not from lowering spending. None of that's happening. And I would say that the fight against deflation is, they take out an entire arsenal of tools to fight deflation very quickly. I don't even know if we're going to have deflation for more than a month ever again, the way they fight. But the inflation fight, to me, looks like a longer, slower, more, it's not as same with the same aggressive behavior that they do with deflation. That's how it appears to me. And that happened, not only in the COVID crisis, it happened during the financial crisis. It started there, and it kind of like seems that maybe that's what the market is also fearing, that when something that in the equity markets might fear that if something hits the markets to make them go down, the reaction is going to be so fast and so swift that they're just going to reinflate in a matter of months.
Well, that was great, D. That was the opening bell. Just interesting things mentioned. First, Rob said, but isn't it possible that technology innovations are also pushing inflation down faster rate than the monetary consumption? We can have these now, but maybe something to discuss tomorrow. Also, Chuck mentioned something interesting. A friend of his in Australia who trades currencies says the currency markets are 4 to 5 times bigger than the stock market, which is interesting because it's almost like crypto, right? Because they can be traded 24 hours a day all over the world. It makes it a much
Right.
more active and tradable market than the US market, where the restrictions to trade the stocks are a lot, right? It's hard to
Right.
open an account
Yeah.
if you're overseas and different regulations. It makes it much harder than currencies.
Definitely.
Pre-crypto even were always traded all over the world 24 hours a day. So that's
Yeah.
interesting. But anyways, great job, Demon. Maybe 2 things we can look at tomorrow. You have a great day,
Yeah.
my friend.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.